All right, let's jump right into this explainer. Today, we're unpacking a really specific and honestly fascinating long-term investment thesis on Ouster, ticker symbol OUST. We're going to map out the mathematical road to a potential 10x return by the year 2036. So here's the specific scenario we're working with today. You bought into Ulster in May 2026 with an average price of exactly $23 a share. That number is the absolute anchor for our entire fundamental and technical analysis today. Now look at where we are today. The price is bouncing around $43 to $45. Even with all the wild summer volatility, your position is sitting on roughly a 90% gain from that May entry. That's a huge cushion right out of the gate. But here is the ultimate goal, $230. That is the ambitious 10x target you want to hit over a 10 to 20-year horizon. Look, turning a great initial trade into a decade-defining compounder is literally one of the hardest things to do in investing. You've got to have conviction. So does Ouster actually have the fundamentals to pull this off? To figure that out, here's our agenda. We'll look at the 10x return roadmap, the business model and leadership, fundamental and SWOT analysis, technical price action, risks to the thesis, and finally, the long-term verdict. Section 1, the 10x return roadmap, the math behind a decade of compounding. Let's reverse engineer the math here. To take that $23 entry up to $230, Ulster has to maintain a massive 25.9% compound annual growth rate for a full decade. Think about what that actually means. Their market cap needs to swell from $2.9 billion to around $15.4 billion. That requires scaling top-line revenues from a $220 million run rate up to something like $1.5 to $2 billion. And, crucially, it assumes the market starts valuing them less like a hardware manufacturer and much more like a high-margin software company. Section 2, business model and leadership. The transition to a physical AI perception layer. So, how do they get there? Well, it all starts with their business model. Ouster's massive competitive edge is that they are leaving bulky, legacy analog hardware entirely in the dust. They've moved to scalable digital silicon. By packing highly efficient VCSL lasers, which are basically tiny, dense light emitters, and ultra-sensitive SPAD detectors right onto custom microchips, they're riding the Moore's Law cost curve. They aren't assembling thousands of expensive mechanical parts. They are literally just printing chips. This allows them to slash prices and scale in ways their legacy competitors just can't match. For this whole 10x thesis to pan out, they need to execute 3 key steps. First up, commercialize physical AI. They have to move way beyond just self-driving cars and become the core perception layer for things like humanoid robots and autonomous yard logistics. Second, they have to scale their software monetization. Hardware gross margins might cap out around 50%, but there are proprietary Gemini and Blue City software subscriptions. Those pull in 80% plus margins. And third, they have to maintain dominance in custom silicon to keep driving those manufacturing costs down into the floor. Of course, a vision like that is only as good as the team executing it. You've got co-founder and CEO Angus Pacala, who brings serious capital discipline to the table. He drove the cost-saving merger with Velodyne and snagged Stereolabs to push aggressively into the spatial camera and robotics market. Then you have co-founder and CTO Mark Fritschel, whose sole focus is driving that proprietary digital silicon roadmap. These guys know exactly what they need to build. Section 3, fundamental and SWOT analysis. Evaluating the financial engine. Let's pop the hood and look at their fundamentals. The Q2 2026 numbers are pretty wild. Revenue hit $54.6 million, which is a massive 56% year-over-year growth, driven by a record 17,000 units shipped. Now here's the best part. They have a fully funded runway. We're talking $263 million in cash, absolutely zero long-term debt, and an industry-leading 49% gross margin. Adjusted EBITDA is still slightly negative at $4.5 million, but it's improving fast, up 19% year over year. Right now, they're trading at roughly a 12x forward enterprise value to sales premium, so the market is definitely pricing in that continued explosive growth. But hey, we have to keep it objective and look at the whole SWOT picture, right? On the strength side, their multi-market diversification is fantastic. They aren't just completely reliant on one single automaker. They're in robotics, industrial, smart cities. However, the weaknesses are real. They still lack GAAP net profitability. They lost 27 cents a share in Q2, and their operating expenses did drift up by about 10%. Plus, they rely heavily on Benchmark Electronics, a third-party manufacturer, which definitely adds a layer of supply chain vulnerability you need to keep an eye on. When we crunched all of this into a 10-year valuation model, we get a really interesting probability matrix. The base scenario, which has a 55% probability, puts the stock's intrinsic value between $80 and $130 as they become a standard in industrial automation. But remember your $23 entry? There's actually a 30% probability of hitting that ultimate bull scenario of $230. To pull off that 30% chance, Ouster has to absolutely dominate the non-automotive physical AI space and push those high-margin software revenues past the $500 million mark. Section 4. Technical Price Action. Charting the 2026 volatility journey. Let's talk about the emotional roller coaster you've been on since May. You nailed that structural floor entry at $23. Then, momentum took over and the stock went absolutely parabolic, hitting an all-time high near $60 in June. But then, boom, a July equity offering at $55 cooled things off, and by August it dropped down to find strong support around $35, right near its 50-day moving average. Now it's bounced back and is consolidating in the mid-40s. Technically speaking, we really need to see a high-volume break back above $55 to go retest those summer highs.
Section 5. Risks to the theses. Identifying the major threats to a 10x return.
Now, as much as we love the setup, Ouster does not operate in a vacuum, and we have to talk about what could derail this whole 10x thesis. First is the good enough vision AI risk. If advanced 2D cameras and neural networks, think along the lines of Tesla's occupancy network, prove to be good enough for robotics, LiDAR could literally be engineered right out of the equation. Second, you've got Chinese competitors like Hesai and RoboSense. They have massive, state-backed scale and could aggressively deflate hardware prices faster than Ouster can adapt. And finally, share dilution. If they need to raise capital for M&A, the share count goes up, meaning that $230 target becomes mathematically way harder to hit. Section 6. The long-term verdict. Portfolio positioning for the focused learner. So what's the final verdict? Based on the intrinsic value and fundamentals we've covered, a 10x return from your $23 entry is actually a plausible upside scenario over the next decade. Because you're sitting on a cushion of nearly 100%, you have the luxury of letting this play out. It perfectly aligns with your 10 to 20-year holding timeframe. That being said, from a strict risk management perspective, if this position gets too oversized in your portfolio, it's pretty standard practice to trim some partial gains if it hits that $55 to $60 resistance zone, and then just let the rest ride.
Which brings us to the ultimate question. The fundamental roadmap to a 10x return is mathematically clear, but the price action is going to be incredibly rocky. You've already seen it go from 23 to 60, down to 35 and back to 45 in just a few months. Do you have the patience and the stomach to hold through that kind of wild volatility for the next decade of the physical AI revolution? Because that, right there, is the true test of finding a generational compounder.